afternoon everyone, and welcome to our session. Today we're going to be talking about break-even analysis for the hospitality industry. My name is Deborah Adams from Arena for Finance, and I'm broadcasting to you from sunny Dorset in the south of England, where it's an amazing 18 degrees today. So after this session, I hope that we're all going to be able to enjoy the sunshine. So let me share with you the slides for today's presentation. Okay, so a little bit about Arena for Finance before we start. And we, as you probably know, offer a range of webinars, short courses, a variety of different opportunities to learn more about hospitality finance. And we're going to be also offering new for 2022 an online subscription service giving you access to a range of resources to enable you to follow some self-paced learning more about different aspects of finance within the hospitality, hotel, restaurant sector. And so that new subscription service will look like this, and you'll be able to log in and gain access to a range of resources. But let's bring us back to what we're going to be looking at today. So in terms of looking at break-even analysis, it's become far more important to know our break-even point. You could argue, well, at any time you need to know it, but obviously we've had such fluctuating levels of revenue that it's been really important to be able to know what level of profitability we have and what level of revenues we need to achieve in order to reach our break-even point. So we're going to be looking at how to calculate break-even today. So it's quite a practical session with a range of calculations that we're going to be following. So let's start off by looking at the operating statement. And this operating statement is based on the style of the profit and loss account from the Uniform System of Accounts. So showing the different departments within a hotel. So we've got these listed here. And the split between the revenues. And with my example here, I've got quite heavy weighting on the rooms part of the revenues. And then as we come down to the bottom, we have gross operating profit. And then if we move to the next, the next stage from that statement would then be to move on to look at the overheads. So what we're interested in today is how do we work out the break-even points for each of our departments. And in order to do that, then we need to focus on what are the costs within those departments. So having got our revenues, which we know are a function of average spends and volumes of customers, then when we look at the costs, we need to know, are those costs variable costs or are they fixed costs or a bit of both? So break-even analysis is all about knowing what types of costs you have rather than which part of the P&L do they sit in. So we want to know how those costs behave so that then we can work out how they will change at different levels of revenue. So I'm going to talk about that bit first of all. So this is a very, very summarised little statement for accommodation, and equally for food and beverage. Again, we've got the variable cost, and it's quite a big one here because the cost of sales, so the cost of food, is the cost of is the variable cost. We've got variable cost there with the cost of sales, and there may well be some variables also in payroll and related costs and operating expenses, but also fixed costs. So just to remind ourselves of the definition of each of these costs. So the definition of a variable cost is a cost that changes in direct proportion to the level of sales. So when we have zero sales, then there'll be zero cost, as you can see on my graph here. And then as the level of sales, and this is sales based on units of sales, so selling more and more of a particular type of revenue, then the variable cost changes in direct proportion. Well, at least the accountant's view is that the variable cost changes in a linear way. Actually, in practice, it's more like the economist's view, which is that this is a slight curve. But for the purposes of our calculations, it's easier if we treat it as a straight line. So when we talk about the variable cost, we mean that additional cost you incur every time you serve a meal, for example. It's the additional cost of the food on the plate or the drink in the glass. Or it could be, in the case of rooms, the cost of acquisition, i.e. the cost we're incurring in order to generate the sale, particularly if we're using third parties like online travel agents. And then at the other end of the scale, we have costs that are called fixed costs. So fixed costs are costs that you have regardless of the level of revenues or sales. So fixed costs mean that even when you have zero sales, zero revenues, you still have those fixed costs. And that's the challenge, isn't it, really, that, as we saw during periods of closure in 2021 and 2020 during the pandemic, then what do we do with those fixed costs and how to manage those? Because trying to lower the bar, trying to lower the line is really tricky. And of course, you want to be ready when you need to reopen, as many of you will have experienced during the last 2 years. So the fixed costs, they are a challenge when revenues are low. So when you're down this end of the scale of the graph, then managing those fixed costs and trying to achieve a profit is obviously a challenge. But as our sales or the volume of business grows, then of course the fixed costs become far more manageable for us and actually help us to achieve more profitability. We have more flow through to profit. And then, of course, there are some costs which are a bit of both. So some costs are partially fixed and partially variable. And so with those, the key is really understanding which ones are they. So it's often payroll, might be a combination of fixed and variable. So you've got your permanent staff would be the fixed costs, and then any overtime or agency staff would be variable costs. And then utilities, another example of costs that are typically partially fixed and partially variable. And the challenge with utilities is often knowing which bit is which, which part of the total cost for, say, electricity is fixed and which part is variable. So the fixed element is, the lighting that you perhaps have throughout your building, whether you have 10% occupancy or whether you have 90% occupancy. But then, of course, you will be using more electricity as you move from 10% to 90% occupancy. But it's quite tricky to actually define that element of fixed and variable. So we're going to look at a method for doing that a little bit further along in the presentation. So a really key relationship in break-even is the idea of contribution. So contribution is what you have left when you take the selling price of your product or your service and you take off the individual variable costs, so the variable cost for selling each one, and that leaves you with something called contribution. So in order to make a profit, that contribution must be positive. So I know it sounds obvious, but it means that we really need to take care that everything we sell, whether it's a room, whether it's a meal or a drink, or it's an event, that we're covering the variable costs of that activity. Otherwise, we don't stand any chance at all of making a profit because we still have to cover our fixed costs in order to get to profitability. So this is a really important relationship, although you don't really see it in the standard profit and loss account because the profit and loss account is focused on departments and the variable costs and the fixed costs are all mixed up together. So you don't have like a clear measure of what contribution you're making. So finding out your contribution is usually part of the costing process. So it's a good idea to look at everything that you sell and then collect together all of those variable costs. So just in the same way as you have, say, a standard cost for a menu item in the restaurant, so there would be a standard recipe and a standard cost, that would help you to work out the variable costs. But you also need to do that for everything else so that you've got a clear picture of what the variable costs are. So, for example, if we were selling a bedroom, then this section in the middle could be a standard cost for the preparing of that room for it to be sold again the next day with a new customer. So I've just got literally some nice easy figures in here in terms of the costs, but it's like creating a standard recipe, but a standard recipe for a bedroom. And then you can match those variable costs with whatever your selling price is to work out what contribution you're making from that sale. And then that contribution goes towards covering our fixed costs. So I think I've just gone backwards there, so let's go forwards. Okay, so the key is to ensure that we maximise the contribution whilst maintaining value for the guest and ensuring that we're going to be able to still generate that sale. But really focusing on what are all the variable costs, and of course one of the chunky costs here on my list is the cost of reservation. So that's if we were going through a third party or online travel agent, for example. And often that cost gets forgotten, but that's part of the variable cost as well. And so if we can improve our selling price, if we can reduce our variable costs, then we will improve the contribution. And that's going to help us to reach our break-even point more quickly. We can do the same thing for food and beverage. So here I've got a very short example of the calculation for the contribution from selling a menu item. So the cost of sales, the £10 that I've got there, that would come from a more detailed standard recipe for that particular dish. So here I'm assuming that we're selling one dish for £35, that the cost of sales for that dish is £10, and that cost of sales has come from listing all of the food and its latest cost, so latest cost of that food, as part of the standard recipe. Then there may well be other variables. So of course we will recognise that the selling price minus the cost of sales equals gross profit, and often the gross profit is the contribution. But you may have a few other variables. So every additional customer might use another napkin, for example, that needs to be washed. So that would be an example of other variables to take into account. So it's really a case of kind of walking through the guest experience and thinking about what extra costs are incurred, so that then we come up with an accurate picture of what the contribution will be. Now I can hear you thinking, well, what if the meal isn't £35? What if we're selling meals at all different prices? Then do we have to do this for every single combination? Well, no. So we're going to talk about looking at contribution as a percentage a little bit further along into the presentation, which takes into account then what do we do when we sell lots of different items at all different selling prices, which of course is the reality, isn't it? But in order to start off with our introduction to break-even analysis, I'm going to do it on a per product basis, and then I'll move into looking at it on a combination of products basis. So again, as we saw with the accommodation sales, is all about maximising the selling price, making sure you're covering the cost of the food, and of course in today's environment constantly monitoring that because that's changing all the time, and ensuring that we're generating sufficient contribution. So far we've said that it's important to review all of your variable costs, so making sure that you know what all the variable costs are for the different products and services that you provide, and then from that reviewing your fixed costs as well. So you've got a clear picture of which costs are variable, which costs are fixed. Some of those might be semi-variable, so have a bit of both, like the energy we mentioned earlier is a good example of that. And looking to see also that every cost justifies its position in the profit and loss account. And then from that, looking at where we can generate additional revenue to generate additional contribution. So let's get back to looking at the break-even calculation. So on the screen I have some very simple values in terms of looking at sales, variable costs, contribution, fixed costs, and do we make a profit or loss. So we've said already that the sales minus the variable costs equals contribution. So here 50 minus 20 equals 30. And then if the fixed costs on a Monday are 75, then clearly we appear to be making a loss on that day. Now, if we were to complete the rest of the table, well, we know from what we said already that variable costs change in direct proportion to the sales. So we would expect then if the sales double to 100, we can assume the variable costs double as well. And this is assuming that the sales are increasing because we're selling more units rather than because we're just increasing the selling price. So we're assuming here that we are doubling the volume of sales rather than the average spend. And that then enables us to assume that the variable costs are doubling as well. The contribution, 50 minus 20, fixed costs, to arrive at our profit figure. So if I fill in my table, we can see here I've made that assumption that these variable costs are basically 40% of the sales at every level that we have here. Fixed costs, by definition, stay the same. Remember the graph, it was a flat straight line. So the fixed costs stay the same right the way across. So on Mondays and Tuesdays, we're making a loss. On Wednesdays, Thursdays and Fridays, we're covering our fixed costs and making a small profit. So the break-even point must be somewhere between 100 and 150 pounds worth of sales with this little mini example. So should we close our business on Mondays and Tuesdays because clearly we're loss-making on those days? And initially that might be our thought, well, perhaps we should close and reduce the amount of loss made. But the challenge then is, where do the fixed costs go? Because you'd still have them. So if we closed on Monday, we would make a loss of 75 if we didn't have any revenue that was generating a contribution towards those fixed costs. So that very often happens in our businesses, particularly if we're seasonal, so seasonal within the week or seasonal within the year. Then we have periods when we're loss-making and periods when we're profit-making. But what we're doing during the loss-making periods is making a contribution towards the fixed costs. So what we need to do in order to be able to get to the point of working out our break-even is to be able to analyse our costs into which ones are variable. So you can see on my graph as a proportion of the total cost, that variable cost is constantly increasing with the level of customers, and the fixed costs stay constant. The fixed costs don't stay constant forever, so although this graph illustrates that those fixed costs are the same level from the start across to over here on the right-hand side, of course in practice the fixed costs will jump up, so they won't stay fixed forever. So for example, if you rent your restaurant on the high street, your restaurant space on the high street, then the rent is a fixed cost. But if you wanted to expand your restaurant, then the rent would jump up, so the rent would increase. You can't just assume it's a fixed cost for any level of volume of business, because you would reach full capacity. Similarly, if your payroll costs are part of your fixed costs, then clearly as you grow the number of customers, then that cost will jump up. You will need more permanent staff in order to manage the level of customers. So fixed costs don't stay fixed at that level indefinitely. They will step up to the next level. And again, that's quite useful to know when that happens. So what do we do if we have a cost which is semi-variable? Well, one way to track that cost is to look at it over a period of time to see how it changes in relation to our revenue. There are a number of techniques for trying to break down your semi-variable costs, but this is probably the simplest of those methods, apart from actually being able to dig down into your bill and find out if it's split into fixed and variable, which it might be. There might be a standing charge and a usage charge, so you could do it from that. But if you don't have the data to be able to work out the fixed and variable costs apart from just the total cost, then you can compare it to the revenue. So we can see with the example that we have here on the screen that we've got revenue of 10,000 and revenue of 16,000, and we can see how the cost has changed. So the cost has gone from 3,500 to 4,400, which corresponds with a change in revenue of 6,000. And we've taken the highest and the lowest values. If you're looking this up afterwards, it's called the high and low method. And the idea is if you have a wider range, you get better accuracy in your calculations rather than just using the difference, say, between January and February. And so then what we do is look at that additional cost, which was 900, divided by the additional revenue, which was 6,000. And if I turn that into a percentage, it's 15%. Now what that is telling us is that the variable costs are 15% of the revenue. So then I can apply that to my figures I have already. So I've got here a picture of when the revenue is 10,000, then the variable cost will be 15% of that. And that means that those variable costs are 1,500. So I'm using these figures up here, this 10,000 here, and looking at this 3,500 over here. So the variable cost is 1,500. And so if I look at the total cost, 3,500 minus that 1,500, then I'm left with fixed costs. And if you try this out on the data, then you'll find that as you work through, the variable costs will be around about 15% and the fixed costs are 2,000. And you can use that then to forecast what would be the utility cost as the revenue changes. But of course it's also useful for us today because we want to know fixed costs and variable costs in order to make our break-even calculations. So how do you calculate the break-even point? Well, the break-even point is the fixed costs for a time period. So you could do break-even per day, you could do break-even per week, per month, per year. So when you look at the fixed costs in the formula, it has to be for that period. So your daily fixed cost or your weekly or monthly or your annual figure. Then you need to know the contribution from what you're selling. So we had just now contribution from a bedroom sale. Now, I know that you're selling rooms at all different prices, so you'll have different contribution figures, but bear with me, we will come to look at what do we do in that situation. But to start off with, if we're just selling one type of product with one level of contribution, then we can take our fixed costs, divide the fixed cost by the contribution, and that tells you the number of rooms you'd need to sell in order to cover all of those fixed costs. And that's our break-even point. So with an example, so coming back to this example that we had earlier, then our hotel has daily fixed costs of 10,000. The average contribution from each room is 234. And so in order to find the break-even point, we divide 10,000 by 234, and we need to sell 43 rooms to break even. And then you can convert that into your occupancy to see what break-even occupancy you need to have. So we're using the 234 that we calculated from our costings earlier. So the formula, just to remind ourselves, is the fixed costs divided by the contribution. Now, if we can bring down the fixed costs and if we can increase the contribution, then clearly we can reduce the break-even point, which is what we want to do because we want to reach profitability, obviously, as soon as we can. So the relationship we're looking at is really the point when our total costs, which are made up of fixed and variable costs, the point when the total costs equal the total sales. That's another definition of break-even. And those total costs are made up of, and as you can see on the graph, the fixed costs, which is where my arrow is pointing at the moment, the fixed costs, and then the point where the two lines cross, which is the break-even point. And then from that we can read off what volume of sales or revenues we need to have in order to break even. But with the break-even chart, which you often see in feasibility plans, business studies, business plans rather, the graph itself is a nice visual representation of break-even, but actually in practice it's better to do the calculations rather than to try to read off values from this. But that's where the profit would be, and obviously that little section there is the loss. But what do we do when we sell lots of different things? So obviously in our hotels you've got lots of revenue streams, and within each department you've got lots of revenue streams as well, because you're selling the basic product at all different selling prices depending on whether the product's slightly different, you have different rooms, different styles of rooms, or just simply different rates to different markets at different times. So we need to then think about the contribution as a percentage. So the contribution, we've said, is the selling price minus the variable costs. And then if we turn that into a percentage, then it's known in the accounting as the CS ratio, the contribution compared to the sales. And once we turn it into a percentage, then that makes it a little bit more manageable to use for break-even, because there aren't really very many of us who just sell one product. And the formula that we've looked at so far is really focusing on just the sale of one particular product. So there's slightly more complicated figures now, so bear with me. If we here have 400,000 as our total sales, and let's say that 200,000 comes from accommodation or room sales, 120,000 from food, 80,000 from beverage. So that's our sales mix. Nice easy numbers for this bit: 50, 30, 20, and obviously together make 100. Now the variable costs, the cost of sales for these different types of sales are going to be quite different. Typically, cost of sales for accommodation is treated as zero, or at least the uniform system recommends that the cost of sales, i.e. the material costs for accommodation, will be zero. Whereas for food and beverage, there's the food on the plate, the drink in the glass. That is what makes up this cost of sales percentage here. But different hotel groups do slightly different things with this. So you might put the cost of acquisition into these cost of sales here, and that's fine. It's just as long as you know what your variable costs are in total. So then I've got another column here for other variables. And so if we read across the table, so for accommodation, we're saying if the sales are 100% for accommodation, then the cost of sales is zero. The other variables are 20, so that leaves us with 80% contribution. Whereas for food and for beverage, well, I've put in that the cost of sales are 40 and 35. Then I've got some other variables here giving me these remaining contribution percentages. And quite typically, the contribution percentage from room sales will be quite a bit higher than the contribution percentage from food and beverage. So what do we do with this? Well, this is probably the most complicated part of today's presentation, but what I've done here is I've taken that 400, so that was the total sales up there, and then I've applied all my percentages that were in the previous table to calculate this little mini profit and loss account, and then I've put in some fixed costs down here. So we've got, for rooms or accommodation, sales, no cost of sales, so the gross profit is 100%, but there were some other variables, so that was my contribution there. Then the same for food and beverage, same structure, but now I've got some cost of sales in here, leaving me with gross profit. And here in this example, there are other variables as well. So maybe some part-time salary hours, maybe some laundry costs, to give us some other variables here to result in this contribution. And then these were the contributions from my previous table. So 80% for rooms or accommodation, 22.5 and 21.25. But the new interesting number is this one. So this one over here, this one over here, the 51%. Because that is my weighted contribution. And this 51% here will vary if my sales mix changes across the top here, or if my variable costs change. But this is my weighted average for contribution. And so if I want to work out my break-even point, what I then do is take the fixed costs, and this time I divide by 0.51, so the CS ratio. And instead of getting the break-even point in terms of how many bedrooms or how many rooms, instead I've got the break-even point in revenue. So this is in pounds in this case. And then if I wanted to know the split, I could apply my sales mix to that to work out what level of sales I should have from the rooms, from the food, and from the beverage. So this methodology, if I just take you back a slide, you can also use this for the different products that you sell within a department. So you could do this for rooms, but you'd split it into the different room categories and then work out an average CS ratio from that. So you need a spreadsheet really to be able to do this, so that you end up with this all-important figure here of the CS ratio, and then that helps you to work out your break-even point in sales. So although in my example I've used rooms, food and beverage all together, in practice I'd probably just do this for rooms and then just do it for the restaurant, the bar operation. If you've got an event, then do it for that. I would perhaps really in practice work out the break-even points for the different areas of the hotel rather than trying to do it for the whole hotel, because you've got here with this 51%, it's dependent on quite a lot of variables. So it's dependent on the contribution from each of the departments, and it's dependent on the sales mix as well. And that's why working out the break-even point for a hotel has always been quite a tricky exercise, and it's probably only in the last year or so that we've actually the last 2 years, we've actually had a go at doing it. And there's been various reports coming out around what is the break-even point for a hotel, and data from Hotstats and STR suggests that it's around about 30 to 40% occupancy. So it's still focusing really on the room side of the business for the calculation, but it will be different for every hotel. So those are only averages and general assumptions really. So the key is that if the sales mix changes, so here I'm bringing in the sales mix to change to 40-40-20, then we would need to recalculate our CS ratio. So assuming that the actual CS ratios per department or per area of the business stay the same, so assuming that they are constant, then the sales mix will change the resulting CS ratio. Now, you don't actually have to go through and recalculate the whole model again. You can shortcut it, which is what I've done here. So I've said, well, I know that 80% of the rooms have a CS ratio of 80%. I multiply that by 0.4, then that gives me 32. This figure, 22.5, multiplied by 0.4, that gives me 9, and then the same for beverage. Now, these numbers on their own don't mean much individually, but you need to add them together to get the new CS ratio. And the new CS ratio then can be used to work out what your break-even point will be if you're able to change that CS ratio. So we've now got 375,690 as the level of sales we need in order to break even. So if I take you back to backwards at this point. So if I take you back to this table here, the key really is understanding our variable costs and our fixed costs. And that really comes from, if I go back a couple of steps further, that really comes from, not very good at going back today, that really comes from understanding our understanding our costs for each activity. So listing the variable costs and really getting a good understanding of what is the cost every time we have a transaction. So the variable costs, the only way really to get a good picture of these is to have these costings and keep them up to date, which actually in today's world is really important because, as we know, all kinds of costs are increasing at much higher rates. We had inflation of over 6% announced yesterday, but I think we know in hospitality that inflation is actually running at a much higher rate in some of these areas, particularly for labour and particularly for utilities, energy costs in particular. So keeping this little calculation up to date is really key because that can help us with so many things, setting the selling price, knowing what the margin will be between the selling price and the contribution. And of course, doing this for our menu costings as well and keeping those up to date. So I'm just going to endeavour to move back forward again. So we said then with our break-even point, the CS ratio is actually a more practical measure. So looking at the contribution margin divided by the sales as a percentage. So you can then use this if you have, say, a variety of different types of rooms that you're selling with different selling prices, but then you're looking to see, is the CS ratio the same for each of those different room types? i.e., is the margin or the relationship between the variable costs and the selling price the same in each case, the same sort of percentage? And that in itself is a very useful activity, even if you're not planning to go all the way to calculating your break-even point. And then we said you start to combine what you're selling. So I've got here accommodation, food and beverage, but this could just be the combination of the different room products that you're selling or the different menu items that you're selling, which would be useful if they have different CS ratios. And then you can look at the weighted average for those values, as we had with our table here. So then by changing our sales mix, and we know when you look at your P&L on a monthly basis, you know that your profitability changes if you have a change in the sales mix between rooms, food and beverage and your other departments. We know that from our experience that rooms creates a greater flow through to gross operating profit, and that's because more of the room sales per pound will go through to GOP because of the low level of variable costs, but then making a contribution to the fixed costs. So have a look at your sales mix for your operations. So this could be the sales mix within a department and ensuring whether we have a constant CS ratio for each of the different products that we're selling within that department. Or if you want to go the whole hog and do the break-even point for your hotel in total, then you'll need to look at the sales mix between the different departments and then know the contribution or the CS ratio on average for each of those departments. So calculate the contribution to sales ratio. Now remember, contribution is selling price minus the variable costs. And you will have a very different CS ratio for rooms, food and beverage, and then any other areas that you have in your business, golf or spas, or all the additional revenue area streams that you may have. So look at the CS ratio for each of those, and then from that you'll be able to calculate your break-even point with the fixed costs. Now with break-even, you could calculate it daily, weekly, monthly, annually, but you do need to break your fixed costs down into those timeframes so that then you can work out that break-even point. Now with the break-even formula, which was fixed costs divided by the CS ratio, of course you can also use it to work out what level of sales do I need for a certain level of profit, which you can calculate by just adding that target profit to the fixed costs. So fixed costs plus the target profit and then dividing by the CS ratio tells you the level of sales you need to make that particular target of profit that you had in mind. Okay, so quite a lot to take in, I think, in today's session. If you'd like a fact sheet from today's session, then just drop me an email and I can give you a summary of the main points of what we've looked at today. And really what we can say with break-even, I think it's a really useful calculation to have as part of your toolkit. So a useful calculation for the individual departments in your business, but also things like events. So if you're planning to have, I don't know, a one-off brunch event and you're obviously doing a costing for it, so then list all of the variable costs and list all of the fixed costs. And then that way you can work out how many guests do I need for that particular activity in order to break even. And that's a really useful figure to know, because then you know whether the event is going to be viable or not, you know whether to go ahead with it. So that's a very useful calculation for one-off individual activities. And there's always lots to be gained from making sure you cost these things out accurately. And thinking about whether a cost is a fixed cost and thinking about whether it's a variable cost is very useful as well, because all of these things help to give us a lot more insight into our business. So that concludes the theory for our session today. We do have some deeper, longer courses coming up over the next few weeks. So Finance for Non-Financial Managers course, which is 2 half days, which is online, which takes you into the profit and loss, the balance sheet, cash flows and ratios. And then we've recently launched a new course looking at the uniform system of accounts for the lodging industry, which is the recommended practice for all of the reports that we use in our hotels. And that's a longer course. It goes on over a number of weeks online with self-paced learning with that. And from that you get 3 certificates from HFTP, who own the uniform system of accounts. And of course, with the uniform system of accounts, we've got a new version coming out at the end of this year. So it's very exciting to see what changes that we might see coming out in that version. And we'll be updating our course to reflect that. And then food and beverage cost control is one of our most popular courses. This is a 2 half-day course focusing on menu costings, gross profit calculations, how to improve your GP, reduce wastage, and improve the bottom line. So we have quite a lot going on, so please do have a look at our website for the future activities that are available. And then we'll be back with our next webinar in a few weeks' time. But do keep an eye on our website for the dates of future events. Otherwise, thank you very much for joining me today, and I hope that you found it useful.